Imagine you had $100 million sitting in your bank account. And then you went to a bank and asked to borrow 20 million more. Most people would assume you had lost your mind, or that something was secretly very wrong. This week, that is exactly what happened. Except the numbers were not 100 million, they were 100 billion. SpaceX, 10 days after the biggest IPO in stock market history, disclosed it was sitting on $100 billion in cash. And on the very same day, announced it wanted to borrow $20 billion more. The stock dropped 16% within hours, not because the company is broke, because of something far more interesting and far more important for you to understand than most people realize. Today, we are going to solve this puzzle properly, and along the way teach you a principle about debt that separates how wealthy companies and wealthy people actually think from how almost everyone else does. Here is why this story confuses almost everyone who hears about it. Most of us are taught a simple rule about money our entire lives. Debt is bad, cash is good. If you have enough cash, you should never need to borrow. That rule makes sense at a household level. If you have $100,000 in savings, taking out a $20,000 personal loan at high interest would genuinely be reckless. But here is what almost nobody teaches alongside that rule. The math that governs a company with $100 billion operates by completely different rules than the math that governs your personal savings account. And understanding exactly why changes how you think about debt, leverage, and money for the rest of your life. Let's lay out exactly what occurred, because the order of events matters enormously. SpaceX completed its IPO on June 12th. Raising $75 billion, which grew to nearly $86 billion once underwriters exercised an option to sell additional shares. The stock surged. By June 16th, just 4 days later, shares hit an intraday peak of $225.64. That same day, SpaceX announced it was acquiring an AI company called Anisphere for $60 billion. Paid entirely in stock. Then, on June 22nd, 10 days after the IPO, two things happened simultaneously. SpaceX disclosed it held $100 billion, more precisely $100.8 billion, in cash and cash equivalents. And in the very same filing, announced it was launching its first ever bond offering, seeking at least $20 billion in new debt. The stock fell 16% that day alone. Its third straight day of losses, now down 27% from the June 16th peak. Remember the puzzle from the beginning of this video? 100 billion in the bank, borrowing 20 billion more? Here is the answer. And it has almost nothing to do with SpaceX being short on money. Reason 1. The money was already spoken for before it even arrived. Back in February 2026, months before the IPO, SpaceX used a $20 billion bridge loan from 5 major banks to fund its acquisition of xAI, Elon Musk's artificial intelligence company. A bridge loan is short-term, expensive financing, designed to be temporary. It always needs to be replaced with permanent financing eventually. That bridge loan had a hard deadline of September 2027. SpaceX was always going to need to refinance it. The IPO did not eliminate that obligation. It simply gave the company a public stock price for the first time, which made issuing bonds dramatically easier. Reason 2, and this is the principle that matters most for your own understanding of money. Bonds are almost always cheaper than giving up ownership. When SpaceX raised money through its IPO, it sold a piece of the company, permanently. Every dollar raised that way means existing shareholders, including Elon Musk, own a smaller percentage of everything the company will ever earn, forever. When SpaceX borrows through bonds instead, it pays interest for a fixed number of years, and then the debt is gone. Ownership never changes hands. The company keeps 100% of all future upside for existing shareholders. During the IPO roadshow, company executives Brett Johnson and Gwynne Shotwell told potential investors something revealing. Future capital raises would come through borrowing, not through selling more stock. They were treating the IPO as a one-time event, not the beginning of repeatedly selling ownership to fund growth. Reason 3. Investment-grade credit ratings are extremely valuable, and SpaceX just earned them for the very first time. Moody's, Fitch, and S&P Global all assigned SpaceX investment-grade ratings ahead of this bond sale, Moody's specifically citing the company's, quote, exceptional franchise strength as the world's leading orbital launch provider. An investment-grade rating means pension funds, insurance companies, and conservative institutional investors, who are legally restricted from buying risky debt, are now allowed to lend SpaceX money. That dramatically lowers the interest rate SpaceX has to pay. Borrowing $20 billion at a low investment-grade rate, while keeping $100 billion in cash, earning its own returns, sitting safely in reserve, can genuinely be smarter than draining the cash pile down to $80 billion to avoid borrowing at all. This is the principle wealthy companies and wealthy individuals understand that most people never learn. Cash and debt are not opposites that cancel each other out. They are two separate tools, used for two separate jobs. Balance the financial logic against real investor concern. If the logic is sound, why did the stock fall 16% the same day? 3 legitimate concerns drove that reaction, and they are worth understanding because they apply to evaluating any company, not just SpaceX. Concern 1. The bond offering revealed that the massive IPO haul was largely already committed to existing obligations. The $86 billion did not represent $86 billion in fresh growth capital. A meaningful chunk was always going toward debts the company already owed. Concern 2. Timing and signaling. Announcing a major debt raise just 10 days after telling public investors a confident growth story raised questions about urgency. Markets generally prefer surprises to be pleasant ones. Concern 3. And probably the most significant. With insider lockup expirations beginning as early as August, the public float of available shares is unusually thin right now, only about 5% of total shares outstanding. Thin floats make stock prices swing harder in both directions on any piece of news, good or bad. Here is the lesson this entire sequence teaches you, regardless of whether you will ever own a share of SpaceX. A company, or a person, having debt is not automatically a red flag. The right question is never simply, do they have debt? The right question is, what is the debt being used for? What does it cost compared to the alternative? And does it preserve or destroy long-term value? SpaceX choosing $20 billion in low-cost, investment-grade debt over diluting shareholders further, or draining its safety cushion, is, by traditional corporate finance standards, the financially disciplined choice. The market's nervous reaction was not really about whether that logic was sound. It was about everything else swirling around an extraordinarily hyped, extraordinarily new public company in its very first 10 days of existing. Here is the puzzle, fully solved. SpaceX has $100 billion in cash. It is borrowing $20 billion more, not because it is short on money, but to refinance an existing obligation at a newly available investment-grade low rate, while preserving both its cash cushion and existing shareholders' ownership stakes. The stock fell because of genuine separate concerns: committed capital, timing optics, and a thin public float, not because the debt decision itself was unsound. The lesson for you? Debt is not inherently good or bad. It is a tool. The only question that matters is what it is being used for, what it costs, and whether it preserves value or destroys it. The next time you see a company or a person take on debt while sitting on a pile of cash, you will not need to wonder if something is wrong. You will know exactly which question to ask. If this video helped you understand something about corporate finance that actually applies to your own decisions, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money stories, with real numbers, so the financial world stops feeling like a language you were never taught.